Welcome to Market Call. Thanks very much for joining us. I'm Marilla Fernandez. Gordon Reid on the show today. He is president and CEO of Goodreid Investment Counsel, and he'll be taking your questions on American equities. Here's how to reach us toll free, 1-855-326-6266. You can also email your questions, marketcall@bnnbloomberg.ca. Gordon, thanks very much for coming in. Good to see you.
Thank you. Good to see you.
We have a new cabinet that has been sworn in, and of course, they're going to have to pivot to whatever comes out of Washington daily and hourly. What do you think the next number of years will be like for investors, having seen what we've seen in the past 3 or 4 months?
Sure. Well, I think we've all learned that Donald Trump is a interesting character. He's built on managing by chaos, by keeping people off balance. And I think that it's important as investors to know that volatility is likely going to be here to stay for the term until he is no longer a policymaker, that tariffs really weren't the issue of the volatility. It was really Trump himself, his personality. So I kind of describe it as tariffs are kind of like the trigger and Trump is the gun. And we have to worry about the gun. So don't expect that just because tariffs may be put on the back burner for a while, that it's the all clear.
Yeah.
It's just one episode in an ongoing movie that we have to participate in. So get ready. And I think this is it's a key point in investors' life cycle. A lot of people were very frightened in the middle of April, and I think a lot of people may have made some moves, unfortunately, because of course you sell when you're the most frightened, when you're the most upset, and that tends to be at a bottom of the market, and that's too bad, of course. So here's a chance. If you look in the mirror and think to yourself, do I have what it takes to be a long-term investor with this type of volatility or greater volatility than we saw in April? I'll stay the course. If not, it's time to act. Not to think about acting, but to act, to make changes to your asset mix. Perhaps it's to take more risk off the table, lessen your equity exposure in favor of more stable assets. And I'm not by any means suggesting that people time the market. Absolutely not. But you don't want to be caught in an emotional down cycle. I
don't know what more volatility looks like. That could be, the thought of that is quite scary. What is your take so far on earnings season? What does that reveal to you, given the scenario and the backdrop?
Well, corporate America came into this administration very, very strong, and it's maintained that strength despite what has been thrown at it. And what has been thrown at it to date is mostly the behavioral stuff. So we've seen certainly a drop in confidence. We've seen a drop in confidence on the consumer side. We've also seen a drop in confidence in the boardroom, but it hasn't translated into earnings yet. And it may not, because of course what we see is Trump back and forth. You know, the pendulum swings, and I think we have to be on guard for weakness or cracks in the earnings picture, but so far we haven't seen that. As of last Friday, about 90% of S&P 500 companies had reported, and 78% of them had reported positive earnings surprises, about 62% positive revenue surprises. In terms of valuation, we're pretty much on the mark for a 5-year average. The market is neither cheap nor expensive. I think we have to look to buy good quality companies with established moats, good management, strong balance sheets, good quality earnings. These are key all the time, but especially right now.
Got it. All right, we're going to take a quick break and line up phone calls for Gordon Reid, President and CEO of Goodreid Investment Counsel. He's taking your questions today on American equities. We're back in a moment. Welcome back to Market Call. Let's get right to an email from Kevin. His subject is Lincoln Financial. He says it is cheap and has a good dividend, and I'd like Gordon's opinion on that. Thanks for that. So Lincoln Financial, what do we know about them?
Well, they're a life company, and they sell retirement products, primarily annuities. So from a demographic standpoint, Marella, they're in the,
it's growing.
In the soft spot, the key spot. The demographics are a tailwind for them. They are inexpensive, which is always a good thing when you're buying a company, and they pay a good dividend, and they got good coverage. So there's really no huge warning signs here. I would think that this is a good holding for somebody looking for income. I don't think that you can necessarily expect strong capital appreciation, but certainly from an income standpoint, it's very supportive.
A good steady income from that.
Exactly.
All right, let's go to the phone lines then. Anne is on the line, calling from Scarborough, Ontario. Hi, Anne.
Hello, Gordon, UNH, United Health, obviously at the talk of the town, down by $58. Do you think it's a bargain, or is it dead in the water? And why were they so blindsided by the higher cost of by higher medical costs? Thank you.
Okay, thanks for the question, Anne.
Sure. Thank you. We don't own United Health. We own a competitor of United Health, Elevance, the former Anthem. United Health today, it's sort of the second shoe to drop. Just a few weeks ago, they reported that they wouldn't meet their numbers. Today, they withdrew their guidance. Their CEO resigned. Pretty tough stuff. And when you get right down to it, the background to insurance in the United States is changing. You've got policy demands put on, regulatory policy demands put on these companies. You're seeing an echo off COVID where medical loss ratios are rising, and they're staying high because people are utilizing their plans more than they did. So they put off procedures during COVID, and we're still seeing them coming back in greater numbers, and it's demanding on margins. The problem, I think, is the concentration that United has in the Medicare Advantage and Medicaid space, so risk-based premium business. And that's hitting them hard.
Is any of this threatened by the Washington administration, which wants to cut all sorts of things, and we don't know exactly what the plan forward is for Medicaid?
Sure. Reimbursement rates are a big point of discussion about whether companies are going to be reimbursed based on traditional or historic norms. I think in the end they probably will be, because insurance companies, health insurance companies, are a key part of the American dynamic in terms of health insurance. Health costs in the United States are very, very expensive, about 50% more expensive in the United States than the other countries in the G7, for example. So developed countries tend to have cheaper health insurance as a percentage of their total economy than the United States does. And American citizens are relying on health insurance policies or coverage, mostly through their employers, to pay for things.
Got it. Okay, let's hope that answers Anne's question. We're going to move on to Craig, who's calling from Kelowna, BC. Hi, Craig.
Good morning. A year and a half or more ago, Gordon had recommended Jacobs Solutions. I did purchase it, March of 2024. So, and I know Gordon's talked about it recently, or not recently, but several calls ago, and had said that he's gotten out of it. So I understand that. It has spun off that momentum. So this has created a bit of a tax problem for me, which I'm figuring out. But my question more specifically to Gordon is, do you think I should hang on to this? I'm upside down on both Jacobs and the spin-off company. I like infrastructure plays, so I'm wondering if I should just hang in, or should I get out of both of these? And if so, what would he recommend for another U.S. infrastructure play? That's it. I'll take Gordon's advice. Thank you.
Thanks for the question. Okay, so they provide construction and engineering consultation?
Yes. Yeah, engineering consultation. We own Jacobs, going back to Craig's, and he encapsulated it quite well. We own them. They announced a spin-off of their Mission Critical Solutions division. We were uncomfortable with the potential tax treatment of that for Canadians. Sometimes U.S. companies really don't consider foreign jurisdictions from a tax standpoint, so we have to make sure we do our homework and make sure that our clients are going to be treated properly and fairly. In this case, we weren't comfortable that we were, so we sold it prior to the spinoff. It was a good company, had done well for our clients. In looking at the spinoff and the two pieces that Craig described, we just didn't feel there was a compelling enough reason to re-enter, so we haven't. The second part of his question is, if he were to move away from Jacobs, where might he go?
Is there something similar he could go to?
Yeah, a couple of things that are companies that I could mention that we own in our U.S. small cap portfolio. One would be MCOR, which is an engineering and facilities business. And another one that is perhaps a little bit more volatile, a little bit lumpier in terms of results and therefore stock price, would be a company called Dycom, which is basically rewiring the United States or North America for 1 gigabit internet technology. A lot of rural America really doesn't have state-of-the-art internet, and they do the groundwork.
Why are they volatile?
They're volatile because they have only 8 or 9 major companies or customers that make up 80 or 90% of their total revenue. So if one of those customers, say a Verizon or AT&T or Comcast or even Google, says, well, we're going to defer this project from this quarter to the next quarter.
Big hit for them.
It's a big hit. And the market really isn't tolerant of that type of thing, even though with some homework you can understand why it's happening and perhaps see through it, which we do, and we've done extremely well with Dycom. But there's no getting around the fact that it's got lumpy results and therefore a fairly volatile stock price.
Got it. Okay, we are going to take a break, lining up more phone calls for Gordon when we come back. Gordon, of course, is President and CEO, Goodreid Investment Counsel. The questions today are on American equities. We're back in a moment. Welcome back. Let's go right to your phone calls. John's been holding on the line from London, Ontario. Hi, John. What's your question today for Gordon?
Hi, Marella. Hello, Gordon. Gordon, I'm a longtime holder of Google.
Yes.
It's done well. Recently, it's come under fire, and the reports by analysts are mixed. Either they decoupled from Apple, or maybe there aren't as many searches. Or what do you think of Google for a 12 to 18-month hold and maybe an ad? Thanks very much, Gordon.
Really interesting story here because there's so much going on in the background for Google. There is.
Without question, it's a front and center story. They are, without question, the leader in search. They control about 92% of the total search market. The criticism is that they're going to lose some or all of that.
Through Apple.
Yeah, they are.
Yeah.
Does that mean that you sell Google? Well, I would argue that they're going to recapture some of it because it's going to go to AI, and Google is a leader in AI technology as well. They're not going to hold on to the whole 92%, but I view it as a bigger pie story, that they will lose some of that 92%, but maybe the pie becomes that much bigger that their revenues go up nonetheless, because they only own 75% or 60% or 50%, but it's of a much bigger pie. And they've, as John was mentioning, they've got a lot more going on than just search. YouTube is the preeminent
video search.
Videos. Yeah. They've got about a 2.3 billion monthly average user number. So that's what, a third, 1 in 3 human beings go to.
Can't argue with that.
No, I can't argue with that. Go to YouTube once a month or more. That's pretty powerful from an advertising standpoint. They've obviously got other irons in the fire. Waymo is their autonomous vehicle, their driver system, which is going to be a technology that will be massive. So there's a lot going on with Google. And then when you look at how the market has reacted to all of these stories, they've taken the glass half empty view of it and discounted the multiple on Google to a point where it's trading at below where the average stock in America is trading.
So he's talking about a year to 18 months?
Yeah. We own it in our U.S. large cap portfolio, so my answer would be it is a good holding. I always preach diversification. You always have to defend against being wrong It's part of the business. So diversification and building a portfolio is extremely important, but I think Google being part of that is certainly defensible.
Got it. Okay, John, we hope that helps you out. Let's move on to another caller. We have Joe, I think, on the line, calling from Montreal. Hi, Joe.
Hi, I want to ask Gord about Bank of America. I'm retired. It's been in my cash core holding for many years. And I want to ask Gord, after Liberation Day, of course, it got hammered, and now it's coming back up. Does he think I should take some profits now when it starts going back up, especially with the exchange rate being what it is? Or should I just keep on going until it gets back up to, I think it reached almost 49 at one point. Should I wait till then before I start carrying up some of my winnings there? Thank you. I appreciate your answer.
Okay, thanks for the question.
Great, Joel. There's a lot in there to unpack, because we're not just talking about Bank of America. We're talking about portfolio theory and how you manage your portfolio specifically. When do you trim? Why do you sell? These are core questions to investors. We spend 99% of our time on the buy side. It's fun. We don't own it, so it's not emotional, and we have all the time in the world. Sell side gets a little trickier. We own it. We each have a gain or a loss. I would say it really doesn't matter whether you have a gain or a loss. What you want to do is determine whether, if you didn't own it, would you buy it today? Do you think going today and going forward, it represents a good value? So I'd add that. In terms of trimming, taking some off, that depends on the total portfolio. If it becomes an overweight in your portfolio, then you might want to think about trimming it, depending on whether you have other bank stocks. So there's a lot of different considerations. So I can't give Joe a complete answer without knowing what his portfolio looks like. But these are some of the things you should think about. In particular, Bank of America and the other money center banks, I think, are primed for good times. They trade at inexpensive valuations. They are the beneficiaries of a M&A cycle, which has sort of gone in fits and starts. It hasn't really gotten going, but there's tons of interest. There are companies out there that have acquisition studies filling drawers America-wide. It is very exciting, but it hasn't gotten going quite yet because of the policy disruptions that we talked about off the top. So that's one thing. Steeper yield curve is positive for the banks. They are probably in the best shape they have ever been in, period. Not so much because of their own devices, but because of what happened in 2008 and the regulatory
structure that had to change.
Exactly,
Sure.
and through Basel and through the regulations, they are extremely well capitalized. So a lot of good things to like about the banks.
Got it. Okay, let's move on to another caller then. We have Ron on the line from Cobourg, Ontario, with his question. Hi, Ron.
Hi.
Go ahead.
Hi, Mr. Reid. Thank you.
Sure.
I'm a fairly long-time holder of Lennar. I've watched it go from 35 to 200 and back down to around 115-ish. Mm-hmm. And just wondering what your thoughts on it, because you know a lot more than I do.
Well,
that's why we bring him in. Okay,
thank you very much.
Talk about Lennar.
Well, Ron, we are no longer a holder of Lennar. Earlier, when I spoke of Jacobs, I talked about tax implications, and Lennar as well went through a tax reorganization. They spun off the part of the company that holds the land, and I think it was probably a good move for Lennar. But again, we weren't sure of what the tax application would be, so we chose to move away from Lennar. I still like the home builders quite a bit. They have retracted somewhat based on economic worries of recession, worries of higher interest rates, worries of tariffs, and worries about foreign workers not being available. Lots to worry about, but the fact remains that the United States is underhoused, as Canada is, and has been for a decade or more. There are reports out there of 500, 600,000 fewer homes than are needed in the United States to compensate for natural population growth and immigration. So home builders are they've got business. They just need a good environment. And that environment is largely driven by interest rates. So if we can get a crack in interest rates, which certainly we know President Trump wants, and I think policymakers want under the right circumstances, that would help the home builders a lot and would help these stocks a lot.
Got it. Okay, we are going to take a quick break. When we come back, Gordon Reid shares his past picks. We'll go through that in a moment. Welcome back. Time now to take a look at Gord's last picks, which were May 14th, almost a year ago, May 14th, 2024. And at the time, he chose Apple, which was at 187.43 American, and now up to 209.74. So 12% upside return for both return and total return. And of course, Apple, one of the tech companies that did take a hit. So we'll bring that chart up in a moment and see sort of how far back it's made it in the past few weeks. Yeah. Back up to 210.83. It did spike down in April. Do you still like Apple moving forward with everything going on?
We do. The company itself has kind of been treading water. You know, it really hasn't done much in terms of innovation in the last few versions of the Apple phone. It's forging ahead on the services side. Which is good because it really supports higher multiples because services are stickier and they're higher margin. They represent about 28% of the total revenues right now. The phone itself, though, is the really sexy part. You know,
sure, I mean, that's and they're the thinking of charging more for it now, right?
Well, they are. They really haven't raised prices much in the last number of years. It's an expensive need to have, isn't it? We all have to have our phone. Many of us choose Apple, and it's just one of those costs of life that we rank pretty highly.
We just got used to.
Yeah.
Putting out thousands of dollars for a phone.
Yeah, and Apple is going to do its very best to make it indispensable and to make that decision even easier for us. They launched Apple Intelligence, which is their AI version last fall, I guess it was, and it really hasn't had an impact. But that's not uncommon for Apple products. You know, they're usually late to the game. They usually let other innovators, first adopters, spend a lot of money, make a lot of mistakes, and then they step in and reap the rewards.
Okay.
And they've done that through music and a lot of other phone and a lot of other things. So I think that's going to be a very exciting opportunity for Apple down the road. So it's a core holding. We've owned it since 2005 and have a ridiculously low cost base on it. Something in the neighborhood of $2.50.
Oh, wow.
For our original buy with our clients. Now, we've trimmed it 7 or 8 times over the lifespan of our owning it, because if we hadn't trimmed it, it would have represented just too big a piece of clients' total portfolios and too much risk being introduced to their portfolios. But it's been a core holding and one we continue or want to continue to have.
Are you concerned about the building of the phones in China? Now moving to India, the tariff situation. I know there have been carve-outs, but are you worried about that moving forward?
Yeah, sure. But you've always got to have something to worry about. And, you know, my experience over the many decades that I've been managing is that the times to really be concerned is when you don't have anything to worry about. Because the market gets so exuberant that it takes you to areas that you really don't want to be. And think of the late 1990s as an example. Markets just, it was a great environment. The Cold War was over. The U.S. budget was being balanced. There was a benevolent power in the world in the United States. You know, it was a lot of good things to like. The internet was being built out, and look what happened to markets. In the late 90s, they went straight up. But the internet bubble burst in 2000, and there were a lot of tears. And those are the times to worry about. I think a little dose of worry is a good thing in investing.
Got it. Okay, let's get to your second past pick, which is Euronet Worldwide. At the time, it was $114.95. So again, this was a year ago. American, now down to $110.99, 3% drop for return and total return. They do financial transaction solutions. What's been hitting them?
Well, a few things. One is that they're about 75% dedicated to non-North American operations. So they have 55,000 ATMs around the world. They have 1.2 million point-of-sale machines around the world, many of them not in the United States. So a couple of things have hit them over the last year. One is a very, very strong U.S. dollar, which means that translating back into U.S. currency for reporting purposes has been a headwind. But the other has just been the upheaval in the world and the fact that Europe really hasn't been growing the way a lot of people thought it would. They trade at 11 times earnings. They're very good at what they do. They are growing organically. I think they're a solid hold. Not exciting, but a solid hold, fairly safe, and I think with some organic potential.
Got it. Okay, let's get to your last past pick, which is Uber. Last year was 65.32, now up to 89.20 American. So a 36% upside return and total return the same. Uber has got a couple of things on the move, and they've just got some more room to grow, don't they?
Absolutely.
Yeah.
They've got a lot of room to grow. 4 basic divisions within Uber, 2 of which I think most of us would come up with very quickly because we order Uber Eats and we know that Uber is a verb or a noun. I guess I get an Uber, so those are just part of our everyday lives and growing very rapidly. The other parts are the advertising parts. There's 175 million monthly active users of their app, and they really haven't captured a lot of that advertising potential. And finally, they have freight, which I wouldn't be surprised if they kind of put to the side. It's really taking away from their focus, I think, a little bit. But autonomous driving is going to be a very exciting thing in Uber's life. There was a period there where people thought that it was an extreme negative if autonomous driving were to take over because they're built on drivers. But what they've proven is that the cost of a trip with an Uber taxi being with an autonomous driver is much less expensive. And again, to the bigger pie theory, this is going to be in a huge pie, and they will be a part of it. So we think a long way to go in the life cycle of Uber.
Got it. Okay, we are going to take a quick break. We'll get back to your phone calls with Gordon Reid in a moment. Welcome back to Market Call. Let's go to Sal. He's holding on the line in Toronto. Hi, Sal.
Hi there. Yeah, my question's on Thermo Fisher Scientific. It's in the healthcare services industry. I was interested to know if now would be a good time to make a purchase. It seems to be at a reasonably good price valuation, and so just wondering your thoughts. Thanks so much.
Okay, so 428, so 429.94. It's dropped significantly.
It has, and this is a company that has come up a number of times in my analysis during peer group analysis. So what we do at Goodreid is we'll find a company that we like, and then we'll look at how it compares against other companies in the same industry and sector. Because oftentimes what you find is that from an economic standpoint, one industry or sector will do well because it's got momentum or a wind behind it from various economic factors, but you don't want to end up with number 4 or 5 in the industry and not look for number 1. So Thermo Fisher is a company that's come up in a lot of my analysis as competitive companies to companies I've been looking for. The one thing that's popped out of my analysis is that their revenues are declining or the rate of growth within their revenues is declining. I want to be specific. And that's a warning sign. And it's not a cheap stock. So if you look at a stock that's trading at a premium valuation and it's got fundamentals that are rolling over or not growing as fast as they had in the past, it's a red flag. I would point, Sal, towards something like Boston Scientific, which is also expensive in terms of valuations, but it's got upward revisions of earnings. It's growing faster than its own history, and that's very important for us.
Got it. Okay, let's go back to the phone lines then. Paul's on the line from Prince George in BC. Hi, Paul.
Hi, good morning. Thanks for taking my call. Mr. Reid, I appreciate your thoughts on U.S. Foods Holding Corporation, a past pick of yours.
Yes, yeah.
Tell me a little bit about the company.
U.S. Foods is a competitor to Cisco, the Cisco with an S, and they are a supplier of food products to restaurants and the food service company. The interesting thing, I just talked about peer group analysis, and this is a company where you would naturally go to Cisco and say, well, how does it compare to Cisco? Well, in our opinion, it wins hands down. It's growing faster. It's less expensive on multiple valuation metrics. It's got good management. It's much more stable. So we like U.S. Foods, and it is in our U.S. small cap portfolio. Has been for some time, and has done well for our clients.
And you're happy to keep it?
Yes.
Got it. All right, let's go to an email then. Norm has written in from Montreal. He says, hello. I'd like to know what Mr. Reid has to say about Haiko.
Yeah.
Tell me about Haiko.
Haiko's in the aerospace business. Good company. They're growing rapidly in a very interesting space, but they're trading at 60 times earnings.
Yeah, 269.82.
Yeah, 60 times earnings.
Wow.
And, that's a high bar to get over. There's a lot of air, not to make too many aerospace puns, but there's a lot of air under a 60 multiple if they make a bad move. We've seen many companies trading at really premium multiples. They have a misstep, and all of a sudden their multiple is halved, and there's just no real reason to build that multiple up to what it was. So you're adrift.
Okay, so how did it get to this point? Was there sort of a certain burst of enthusiasm it took off on? Do you remember, or was this sort of just a slow build?
No, that's a good question. I don't really have an answer to it, Morella. I think that I've looked at this over the years. It's always, my memory serves me, been a premium multiple company, but I don't know that there was a one event that led to this. It's in an interesting space. Aerospace brings on excitement and enthusiasm. There can be a lot of growth, but I don't have an exact answer to your question.
Got it. Okay. We are going to stick around with Gordon Reid. He's going to take more of your questions when we come back. Stay tuned. Welcome back. We are going right back to your phone calls. Anita's on the line from Markham, Ontario with her question today. Hi, Anita.
Hi. Good afternoon. Thank you so much for taking my call. My question is on McKesen. I think this too was one of your past picks, Gordon, and I did extremely well in that, except for the last couple of days it's gone down. So my question to you is to pick your brain and see what I should do with this. Should I go elsewhere, or should I hang on to it? I'll hang up and listen to you. Thank you.
All right. So an expensive stock, $685.44. It's gone down $2, I guess, today. You like it overall. They deliver pharmaceuticals.
They do, and it's a high-price stock, but I wouldn't call it an expensive stock. Expensive, like that relative determination of expensive or inexpensive, really has to involve a ratio of what they do to what they cost. So price to earnings ratio, price to cash flow, that type of thing. And I think that McKesen is a classic example of a high price stock that really is a fairly inexpensive stock because it trades at 18 times earnings. So it's got a very, very strong earnings engine behind it that's supporting those $685. So we like it. The last couple of days, I think, are just noise. Yeah, obviously we're in a risk-on environment with the Trump tariff relationship with China. Market's excited. It's buying back into those stocks that it sold off. with rigor in April, and the source of the funds are companies like healthcare companies like McKesen. So to Anita, I wouldn't worry at all about that. Keep your eye on what McKesen does and how well they're executing, and I think you'll be well served. We continue to like them. Much of their growth is coming from the GLP-1 explosion, the weight loss drug.
Of course, yes.
So a lot worldwide. I mean, it's a. Last I saw, they thought it was about a $1.5 trillion total addressable market.
Wow.
And McKesen, as the largest distributor of pharma drugs in the world, is going to make a piece of everybody's prescription.
All of that. Got it. Okay. Let's move on to an email then from Jim in St. John. He says, I was wondering if you could please ask Gordon his opinion on Baxter International. They do also sort of medical products and technology?
They do. They do a lot of pumps and IV dispensers and products. They ran into trouble a few years ago when they bought a company called Hillrom. And Hillrom was, again, in the healthcare area, and they did hospital beds and lifters and, you know, those types of things that you would normally see in a hospital. And it's been a bust. It just has not worked out for them. They took on a lot of debt to do the deal. I talked about GLP-1 drugs earlier. Amazingly, types of companies like these that have patient assistance built into them are just not getting the order flow that they were because people don't weigh as much as they did. It's quite shocking how this has rippled through society, from everything from fast food and sugary snacks to hospital equipment.
Yeah.
It has an effect. And in the case of Baxter, they've really been trying to dig out from under their debt problems. They sold their kidney care division, and from everything I've read, they gave it away. They just had to sell it. They didn't get the price that they should have for it, according to most analysts, and they still have a debt problem. So I would stay away from Baxter.
Got it. Okay, let's get to another email from Catherine. She says, would Gordon recommend Merck for a long-term hold? Let's pull up Merck and have a look at that.
Yeah, that's not a great chart, is it?
It's not.
Yeah.
What has happened here?
Well, it's a pharmaceutical, and they just, as a group, have not done well. It trades at 8.5 times earnings. It's got one very large drug in Keytruda, which makes up 46% of their total revenue.
And what is it?
It's an oncology drug,
okay,
and it's a very exciting drug. It is a cancer drug, and the excitement is that the application is becoming wider and wider and wider. So cocktails are being devised by using Keytruda with other compounds to treat different types of cancer very effectively. So societally, very, very exciting. For Merck itself, you know, the danger of having one product represent almost half of your revenues is very real. Its patent cliff starts in 2028. So parts of it go off patent in 2028. Of course, there's hundreds of patents on Keytruda and parts of it. Another drug that they have is called Gardasil, which is an HPV
yes,
drug. And it represents about 13% of their revenues. But I think the story with Merck, and I talked earlier in the show about employing your capital today and in the future, and if there ever was a chart where if you're an owner of Merck, you'd have to adopt that stance, this is it. It's a terrible looking chart, but I'm saying, what is Merck going to do for me into the future? Well, 8.5 times earnings and dozens of drugs in phase 2 and phase 3 development that are future revenue earners, future Keytrudas, future Gardasils. So I think in terms of pharmaceuticals, it's probably one of the best options. And as a cherry on top, a very fine dividend. And
a good time to get into it with where it's at sitting now.
As a part of your portfolio. You know, if you only went with those stocks that were performing for you now, you'd become what is known in the industry as a momentum investor. Momentum investors tend to be very volatile. They tend to buy late in a cycle at the top and then see it fall. You certainly don't want to be that. You want to have different types of companies at different points of the cycle to make up a total portfolio to smooth the ride.
Got it. Gordon Reid is going to stick around. He's going to share his new picks. Let's when we come back. Welcome back. Time now for top picks from Gordon Reid. Here is his first pick for you, Elevance Health, which is a health insurance provider on the New York Stock Exchange. What do you like about Elevance Health?
Well, we've owned Elevance for a very long time. It used to be called Anthem, and we've liked it because it trades at good multiples. It's a health insurance company, and people will notice that it's down significantly today.
It took quite a drop-off last fall.
It did, yeah. And health companies in general took a drop last fall because of the surge in technology and communication services companies. This is more industry specific. United Healthcare has been having a real tough time with their medical cost ratio. It's been rising. We talked about that earlier in the show. Elevance is a competitor, but it's a different competitor. Its business is structured somewhat differently than United Healthcare's. United Healthcare is an insurance company that relies mostly on risk-based premium collection. So Medicare, Medicaid, Medicare Advantage, and if experiences are that health or insured people spend more money, then, for their premium, their margins drop at United Healthcare. Elevance has 47 million insured people, but 27 million of them are on what is called a fee-based system. So a fee-based system is where I go into a company and they've got a staff, and Elevance says your fee or your health insurance will cost X, and they come back and say, well, no, most of our employees are young, healthy, don't smoke, and so on. So a fee-based system says, okay, well, if that's the case, you pay just this fee, we will insure you to a certain limit, and if you go over that limit, you're on the spot, Mr. Employer. So you put almost an insurer between the insurer and the insured.
The onus is lower.
Exactly,
Okay.
exactly. So when you put that in a nutshell, for Elevance to fall today in sympathy with United Health is overdone somewhat because they don't have the same exposure. They have some exposure to medical losses, and they're dealing with that quite successfully, but not to the extent that the market is indicating. And to that point, at Goodreid, just this morning, we bought more Elevance in our client accounts because of this drop. So I think it's a very appropriate day to have it as a top pick. It's an opportunity, we think at Goodreid, to take advantage of a mispriced situation where people are just in a knee-jerk way reacting to what happened at United Health. And we can take advantage of that, and I'm glad to be able to be here to talk about that.
Got it. Okay, let's get to your next pick. Leonardo DRS, which is a defense electronic system out of Italy primarily?
Well, Leonardo was a defense contractor out of Italy and bought into DRS some years ago, and then just recently bought a piece of an Israeli defense company called Reid.
Okay.
And they've put the total together, and it's now Leonardo DRS. They do military applications, propulsion systems for naval vessels. They do radar systems and advanced communications detection systems. About 80% of their business comes from the U.S. government, but a couple of things are happening in this new era of the new administration. One is that there's extreme pressure for individual NATO companies to do their own spending.
Yes.
And not to rely on the U.S. government and U.S. defenses to protect them. That's going to be very, very favorable for Leonardo DRS. The U.S. Navy has a new class of submarine, and it's a huge project. They're going from one class to another, and they've got a $128 billion defense earmark for that. Leonardo is a a big beneficiary of that. They've got an $8.5 billion backlog, which represents more than twice of their annual revenues.
So lots of room to make some money there. Okay, let's get to your third, which is JP Morgan.
Yeah.
As we wind down on time, JP Morgan, looking forward, what do you like about them?
Well, as a money center bank, I talked earlier about how they're beneficiaries of the current environment, the regulatory environment, the interest rate environment, the strong economy. And the pricing of JP Morgan and the other money center banks over the last month or 6 weeks has been hugely affected, almost 100% affected by whether, as an investor, you thought the United States was going into a recession or not. If you thought that, then you sold off your banks. If you didn't think that, then you think they're pretty good value here. We're in the latter camp.
Got it. Okay, we do have to leave it there. Gordon Reid, appreciate you coming in. Good to see you.
Thank you.
And we'll see you again soon. Let's take a quick look at the markets as we head out. We'll see you again on Market Call tomorrow.